so much, everybody, for turning into the very first class of 2024 with Miami YPN. Today's always a great topic. We typically try and host it at the end of December, but you know how scheduling goes. When you're a CPA, you're a very busy person towards the end of the year, and we are grateful to have Don at any time. So we have Don here, Don Fallenbaum. How long have you been a CPA, Don?
About 25 years.
So
I've actually been
loads of
saying that a
experience.
few years, so it's probably more than that by now.
There you go. So loads of experience. He knows all the loopholes. He knows everything you need to save yourself quite a bit of money moving into 2024 and beyond. There might be some new things that he'll discuss as far as tax laws are concerned, but he's just going to give you a general overview today of how maybe you should structure your business and how you should approach every tax season moving forward. Before we get started with Don, let me make you a co-host, Don. Go ahead and accept that whenever you have a chance. Our sponsor for today, besides Fallenbaum CPA, is the YPN Global Congress. Now, we're getting very close to the YPN Global Congress. If Dubai is on your bucket list, I would love for you to come join us at the second annual YPN Global Congress. It'll be on February 29th. So spend your extra day with us in Dubai and consider flying over. It is pretty relatively cheap still, around $1,000 for your round trip flight. Hotels are at about $250 a night. And the conference itself is only $200 when you use promo code MIA25. If you have any questions about Dubai and how we can enhance your experience there, don't hesitate to reach out to me, Kevin at MiamiRE.com or Instagram at MiamiYPN or YPN.global. And if you're not following YPN.global, please follow us. We are a very international city, and YPN Global can help you with your international adventures. So with no further ado, we have our man of the hour, Don Fallenbaum, with us. Don, the floor is yours. You should be able, let me stop sharing my screen. And if you have a PowerPoint, you have the ability to share it now.
No, PowerPoint, just talking.
Just smooth talking from Don. Put some low jazz in the background, and you're going to have quite a treat for the next hour. So with no further ado, give it up for Don Fallenbaum, everybody. Thank you so much.
Hi, good afternoon, everyone. I'm Don Fallenbaum, CPA, been in practice, like Kevin said, about 25 years or more. And I do specialize in the real estate space, and I help realtors, their clients, brokerage offices, as well as real estate investors. So today's class is going to be on entity selection. And I'm going to start off talking a little bit about the different options. You've all heard about LLCs and PAs and have that shiny PA behind your name on your business card or LLC. But what exactly does all that mean? And then I'm also going to get into some problem areas that I see all the time that is not done properly, and with a little bit of direction and knowledge up front, you can save a lot of headaches down the road and save a lot of money as well. So let's dig in. We're going to start off with enter. Okay, we're going to start off with if you don't do anything. So as a real estate agent, you're considered a sole proprietor. As a sole proprietor, you get paid with a 1099, and that is reported on your personal return on what's called a Schedule C. And that's where you report business income and related expenses, and you have a net profit. So the benefit, there's benefits and cons to that. The benefit is that, of course, it's easy. You don't have to do anything. The limitation to that is that it's going to cost you more money in what's called self-employment tax. Self-employment tax is basically the same as employment tax. It's the same thing. It's an extra 15.3% of the net profit from that trade or business. In this case, it's real estate sales. And then that gets added to your other income on your tax return. So in essence, if you don't do anything, you're a sole proprietorship. You file everything on your Schedule C, and then you have that self-employment tax. The other negative, intangible negative to having sole proprietorship is, or if you don't do anything, is that you have more of a likelihood of getting audited, because the IRS will see all the line items on your tax return, all your various expense items, and it's just more for the IRS to look at than if you didn't have that, okay? So the next thing is we've all heard about LLC. So what is an LLC? An LLC stands for Limited Liability Corporation. When you set up an LLC as a real estate agent, it's what's called a single member LLC, meaning that it's only you that is part of the entity. As a single member LLC, it's what's considered what's called a disregarded entity with the IRS. In other words, it doesn't exist. You can set up the entity. If you do it yourself, you go on Sunbiz, you set up the entity, you go on the IRS website, you get an EIN number, and now you're thinking, okay, now I'm going to save all this money. I'm an LLC. I can put LLC behind my name on my business card. I'm all set. Don, save me a bunch of money. Unfortunately, it doesn't work that way because, like I said, it's a disregarded entity. So you're still going to file a Schedule C on your personal return. It's still going to be subject to self-employment tax. It's still going to show all your various line items of expenses. And it basically did nothing for you from an IRS tax standpoint. It's going to give you a little bit of liability protection, but no protection or no benefits from a tax standpoint. So the next level is a PA. And we've all heard about PAs. So what is a PA? A PA is nothing more than a corporation. Certain professions, instead of having Inc. at the end of the name or having corp or a company, certain professions have PA at the end of the name, which actually stands for professional association. So by default, you set up a PA. By default, from an IRS standpoint, you are what's called a C Corp. What a C Corp, what that is it's taxed as a separate entity at the entity level. And right now, the tax rate is 21% for a C Corp. The problem with the C Corporation, in most cases, is that you have what's called double taxation, meaning that the corporation pays tax on the net profit at the entity level. Then as a shareholder, when you pull money out, aside from payroll, and we'll get into that in a little later, because when you pull money out, you're going to get what's called dividend income. And then that is subject to dividend income on the personal level. So what, in effect, that's where the double taxation comes from. So you're paying tax twice on that same income at the entity level and then at the personal level as dividend income. No different than owning stock in Tesla or Apple or whatever the case may be. So that is a PA. Now the problem areas now what you want to be is an S Corp. What an S Corp is it's still a corporation, except that it's taxed differently. There's no tax at the entity level. Everything passes through to the individual shareholder or shareholders. And then that becomes part of the personal income on the personal return. The difference is that flow through that comes through from the entity, from the S Corp, is not subject to that self-employment tax. And that's where that savings comes in. So depending on your income level, that savings could be quite substantial. Anywhere from, 15,000, 10,000, 20,000 and up. So it's pretty big chunk. Now, there's always a catch to everything. Kevin, how do we change the view on this? Let me see something. Speaker.
Did I change the view? So
I
do you
just
just want the
changed it.
speaker like that?
Yeah, there we go.
Did
Okay.
that change better? Okay.
Yeah. Okay.
I didn't know that controlled everybody.
Yeah.
I gotta figure out how I monitor these people now. I'll put it
Okay.
in screen mode. All right, I'll figure
All
it
right,
out.
got it. Okay. So that'll switch to me then when I speak, right?
Yep. Yeah, it's focused on you now. I didn't know that when I clicked it showed the
Okay.
whole gallery.
Okay, got it.
Yeah,
Okay,
you're
so
good now.
where was I? We're talking about S Corps, okay? So what you want to be is an S Corp, a PA as an S Corp. Now, as an S Corp, like I said, the income passes through to the shareholders, so you don't have that double taxation. So there's no tax at the corporate entity, it becomes part of your personal income. Now, of course, there's a catch. There's always a catch to everything. The catch to that is, as a shareholder of an S Corp, you need to pay yourself what's called reasonable compensation, which is actual payroll. W-2, certain payroll reports that are due quarterly, year-end reports, W-2, and the various other payroll reports. So the reason for that is because as an owner and as a shareholder and employee, you're the one providing services to that entity who's producing that revenue. So you're supposed to pay yourself reasonable compensation. The IRS doesn't like that. You're just getting all the money out as a form of profits and not showing any payroll because you are working for your company. That reasonable compensation changes depending on income level, depending on how much money you pull out of the entity. Now, that brings me to distributions. What a distribution is, the way you take money out of an S Corp is two ways. Number one, what's called shareholder distributions. And what that is, you're simply taking an advance against the profit that you're going to pay tax on at the end of the year. That's called a distribution. The other way is through, like I said, payroll. And the goal is to come up with a balance of both to satisfy the IRS, but to limit the amount of that self-employment tax or payroll tax. So generally, we start off as, I don't like to say a rule of thumb, but generally about 50% distributions to 50% payroll, just to keep the numbers easy for now to explain it. So for example, if you have 100,000 of net profit, you'll take roughly about 50,000 of payroll, which is an expense of the corporation, and then you'll have 50,000 of K1 of profits that will be part of your personal return. So it's the same 100,000, except it's going to be split between payroll, W-2 income, wages, and K1 income, which is basically your profit from the S Corp. Okay. Now, so what you're doing in effect under that scenario is you're cutting that self-employment tax in half. Rather, in the same scenario, if you didn't have the S Corp PA and you're strictly a 1099 on your personal return, you'd be paying that 15.3% self-employment tax on the full 100. When you have the PA, and let's say we use the example of half payroll and half profit, now you're going to be paying it only on the payroll portion. So in effect, you're cutting it in half. So in that scenario, you're going to save somewhere around $7,000 or $8,000 in tax right off the bat. The other intangible benefit of having an entity that's reported outside of your personal return, again, the intangible benefit of not having all those line items of all your various expenses showing up on your personal return, because everything now is reported on a separate corporate return. An S Corp is called an 1120S, a C Corp is called an 1120. So the only number that shows up in the personal return now is your wages on a W-2 and the amount that flows through on a K1 from the S Corp, and that's it. No line items, everything shows up, everything's reported on the separate corporate return, and the chances of a small corporation being audited versus an individual return with a Schedule C is much, much, much less, okay? So that's the intangible benefit of having an entity aside from a straight Schedule C on a personal return. Now, problem areas that I see all the time. One problem is that you go in Sunbiz, you set up an LLC, you come to me at the beginning of the year, January, February, March, to set up, to do your tax return and say, okay, Don, I set up this LLC during the year, save me a bunch of money now. Not knowing that they never did the S Corp election. Okay. Now, I didn't say before that you could also elect an LLC to also be taxed as an S Corp. So let's say you do the LLC instead of the PA, you could also elect with a certain paperwork for that to be taxed as an S Corp as well. So the key here is the S Corp. Regardless of whether it's an LLC or a PA, you want to be the S Corp. Okay. So you come to me in February and say, okay, Don, I did this LLC, now save me a bunch of money. So my first question, did you do it yourself? Yes. So you went on Sunbiz? Yeah. You have an EIN number? Yeah, great. Did you do the S election? What is that? So that kind of tells me, no, I don't think you're an S Corp. Do you remember sending in a form 2553? No. Okay. So you're not an S Corp. So basically you did nothing from a tax standpoint. So, but however, there are ways, as long as the entity was formed in the same year that we're filing the taxes for, I can go back retroactively and convert it to the S Corp as of the date that you set up the entity. So you're not out of luck yet, but there's another step that needs to be done, okay? Now, the other problem area I see all the time is, okay, so you set up the PA or you set up the LLC and you set it up as you did the S Corp election, everything was great there. However, you didn't take another step and you didn't update it with the DBPR. And then after the DBPR, you need to update it with your broker. If you don't do that, you're still going to get a 10, if the broker doesn't know that you set up this entity, you're still going to get a 1099 at the end of the year under your social, under your name, and basically it doesn't exist. So he didn't do any good there either. So now, again, there's kind of a back end way of fixing that the first year, as long as the entity was set up and let's say you deposited all your commissions into a business bank account, but you just did not take that final step and updated it with the DBPR and your broker. What I would do is I would show the gross amount on your 1099 on a personal return on a Schedule C, and then just back out that same amount and zero it out and just say received as nominee for XYZ Corporation or PA, report it on that entity, and then we report everything on your S Corp return. It's not the cleanest way of doing it. I've done it many times. I've never had any issues with the IRS with it. The better way would be to do it right, of course, initially. And now that you're taking this presentation at the beginning of the year, which is great, you'll know that, and that won't happen with all of you guys. Okay. The other area I see all the time is the name. As a real estate sales associate, the name of the entity needs to be exactly the way your license is listed. Okay. If you have a middle initial, the middle initial needs to be on there. If it's a full middle name, it's got to be exactly the way it's listed. If you don't do that, you go to the DBPR, and let's say you know to do that, you go to the DBPR to update it, and they're going to say, sorry, you can't do it. It's got to be your name the way it is on your license. They're going to kick it back. Now what you're going to have to do is do an amendment with the state. You're going to have to name change, and then you're going to have to contact the IRS because your EIN number, it's matched to that name that you had before, and then it's not going to fly. So it just creates a lot of aggravation, a lot of headache down the road. If you're just doing a simple thing by having the right name exactly the way your license is listed. You can't have the greatest real estate agent in the universe, I'm a PA, that's not going to fly. Even though I know you are, it's not going to fly from a tax standpoint. Okay. So that's a very, very important point. So I'm glad we're doing this now, and I'm glad we're doing this in the beginning of the year, because you don't know how many times I meet with a new client, halfway in or 3/4 in the year, and we determined that having this set up could have saved them a bunch of money. And they wish, and we always say, we wish you would have met, 6 months ago. You're doing it at the beginning of the year. It's a perfect time. Now, leading to another question, another point, when does it make sense to do this? Okay. Because there are going to be costs associated with setting up the entity. There's another filing that needs to be done, and there's going to be a separate corporate tax return that's going to be filed. So there's going to be extra fees involved with it. Generally, when you're looking at net commissions, I'm talking net after your various expenses, your association fees and marketing and auto expenses and meals and whatever else, open house fees, whatever else you have, listings, lists, open house fees. The net amount, generally, if it's at least 25,000, you're going to be looking at roughly about a break-even point, where the cost of setting up and maintaining the new entity will pretty much pay for itself at that level. As you go up from there, obviously, you're gonna have a lot of tax savings besides the intangible benefits. So the higher your income, the more tax benefits you're going to get by having that business structure. Under that amount, it may cost you a little bit in having it set up. But if you're looking at, what's in your pipeline, if you have a lot of listings, down the pike, if you're working with a lot of buyers, if you think you're going to grow, then, fairly quickly, then I would say, set it up sooner than later. The cost to set it up is anywhere between, I charge $550 to set up an entity. If you do it yourself, you can go in SunBiz, you just pay the filing fees and do it. but you need to make sure you also do the EIN number, the S election, and do all the other steps. And also, there's also enrollments you need to do on the payroll side of things. Because like I said, with an S corp, you need to pay yourself what's called reasonable compensation. There's quarterly reports that need to be done each quarter, and then there's the annual reports at the end of the year that need to be done associated with that. And there's fees with that as well. So so I would say the break-even point is somewhere around 25,000 or so. And as you go above that, then you're gonna have some decent savings with that. Let's see now. Reasonable compensation. Other considerations that I see all the time for realtors is estimated payments. If when you're a W-2 employee, you have taxes withheld from your paycheck. At the end of the year, presumably, if enough is withheld, you should just about break even when you file your tax return. If you withhold more than what your tax ends up being, you'll get a refund. If you withhold less, you may owe a little bit, but the bulk of your tax will be paid for by the withholding of your W-2 throughout the year as you receive your paychecks. As a self-employed person, whether it's a Schedule C, whether it's real estate or whatever other business it might be, whether you have rental income or whether you do a lot of day trading or trades and have capital gains, you do flipping, whatever the case may be, if you don't have W-2 income that you have withholding on, you're not going to have anything paid into the IRS at the end of the year. So I've seen it so many times where a client or a new client may have a great year, but things come up, you use the money at the end of the year, you may owe $20,000 or $30,000 of tax, you don't have the money. And that creates a whole stressful situation. We try so hard to minimize your taxes as much as we can by taking advantage of business structures, taking advantage of deductions available to you. If you get into the situation where you don't have the money to pay your tax, now you're looking at additional penalties and interest and have to scramble around to try to borrow money, do a payment arrangement with the IRS, and that just creates a stressful situation, which is not necessary. I'm here to help you avoid that. Tax time should not be stressful. It is for me, but the idea is for me to be stressful and stay up all night worrying about it, so you don't have to. Your job is to do your business, focus on that, and I focus on this part of it, so you don't need to. That's what I do. I don't do real estate, I do taxes, I do accounting, so that my clients have the peace of mind so that they don't need to worry about this stuff. But that's something that's very important, and I've seen it over and over and over. And unfortunately, you get into a cycle of every year owing taxes, and then you may have a payment arrangement with the IRS. The next year comes up, you're paying off the prior year, and now you owe money again. So it's something that could be avoided with proper planning throughout the year. And that's another area that I see it a lot. Now, if you put the money aside, I know some agents that I've worked with, they set up separate bank accounts where they call it their tax account, they call it their profit account, or whatever the case may be. The money's sitting there, so at the end they put away 20%, 25%, or whatever it is, and then at the end of the year it's there. Okay. Problem is you need to have discipline for that, because if something comes up, you may need to spend it if it's sitting there. The other issue is this isn't something that's recommended to do. This is something that is actually part of the tax code, that you're supposed to be paying in estimated quarterly payments. If you don't, you have what's called an underpayment penalty. So it's an extra penalty involved if you don't pay it in, even though you allocate and put the money aside and you have the money to pay the tax, if you don't pay it in properly, you're still going to incur a small penalty for that. It's not huge, but nonetheless, it's still a penalty. I'd rather it in your pocket than the IRS's. Okay. The other thing is bookkeeping, record keeping. I meet with a new client. So how do you keep your books? And then they start laughing. So no, okay. I don't think how did you keep your books? I didn't. So again, it's a lot easier having some type of system set up ongoing than having to scramble around come January, February, and March and start pulling everything together for an entire year to get the taxes done at the end of the year. whether you use an Excel spreadsheet. I have certain formats that I put together that's very easy to use. You could use that, or we've all heard of QuickBooks. You have QuickBooks Online, which is great. You just add me or add your accountant as an authorized user. You go in there, pull the information we need, and then everything is there. It makes it very easy. Now, it's not quite that simple, but having some type of system in place to keep track of everything not only makes the record keeping easy from tax time, but it also allows you to keep track of things and knowing where you are. Because from a payroll standpoint, the amount of payroll you're going to take out is determined by what your activity level is. You're not going to take out $100,000 of payroll, if you did $100,000 of gross commissions. It's going to be relative to what your activity level is. So what I typically do with my clients, like my realtor clients, is at the end of the month after the end of each quarter, we get together and say, okay, what was your activity level for that? Assuming I'm not doing your bookkeeping for you. If I am, I would have that information. But I'll say, okay, what's your gross revenues? How much approximate expenses did you have? What you take out in distributions? Based on that, we'll decide how much payroll to do for that quarter. So, you may be thinking, how can I do payroll if my income fluctuates? The payroll will fluctuate based on your activity level. So it's not locked in at a set amount. That could vary and that could fluctuate. You may have a great quarter. We may do a lot of payroll one quarter. You may, in the next quarter may not be great, and we may not even do any payroll. Okay. It's all relative to what you do. But at the end of the year, it should balance out relative to what the income is and relative to what you took out in distributions, how much payroll you took out. I have some clients that prefer to do it all in the fourth quarter. So we do based on pretty much 3/4 of the year, we get together towards the end of the year and we say, okay, how much was your gross commissions January through let's say September, and what's your expenses, and then what do you expect for the last 3 months of the year, and then we determine the payroll portion. But in order to do that, you need to know what your expenses are. You're not gonna know that unless you keep track of it. So again, it could be as simple as a spreadsheet, it could be QuickBooks, it could be whatever system that's set up, and I work with my clients to come up with a system that works for you. QuickBooks is a tool, a spreadsheet is a tool. It's something that works for you. If something doesn't work for you, we're not going to use it. We'll use something else that you could relate to, and it makes it easier for you. That's the whole key, is to make it easier for you. Okay. So now let's say you're having a really good year and you have a decent amount of disposable income, some tax saving strategies. One of them is setting up some type of pension plan. We've all heard of 401ks and SEP plans and simple plans. As an entity, as a shareholder of an S corp, of a corporation, you could set up what's called a solo 401k, where you could defer up to this year up to about 66,000. Depending on what your income is. Part of it is deferred from your W-2 based on the payroll. Part of it is what's called a profit sharing plan that's an expense to the corporation. You are the corporation, you're one and the same. So you could defer quite a bit of money, reduce your taxes, and at the same time building towards your retirement. So it's not just about today, it's about tomorrow, it's about next year, it's about 5 years from now, it's about 10 years from now, it's about 20 years from now. You need to look at it short term, you need to look at it medium, and you look at long term. Because what you do today, 5 years goes by pretty quick. 10 years goes by pretty quick. And if you do the small dribble of a faucet over a long period of time is much better than turning it on all the way for a short period of time. You have a much longer period of time to build up that worth, that net worth, and those assets for down the road so you can retire. And that's what we all want to do. We want to retire comfortably and not worry about financial issues when we do retire. So that's another point I want to bring up to you. As a business owner, you have that available to you. Okay. As far as tax changes, there's always tax changes. I keep up with all of them. As a matter of fact, a new bill was just passed this past week, and I'm actually in the process of looking through everything to see what the changes were. One big issue as far as from a tax law standpoint is, I don't know if any of you recall, back in 2017, there was a big tax reform when Trump was president. A lot of those provisions are due to expire in a couple of years in 2025. So there's going to be a lot of situations, a lot of tax planning that's going to go into effect between now and then, depending on your situation, depending on type of assets you have. If you have rental properties, there's different methods of possibly saving some money by shifting income. If you have kids that could help you out in your business, doing some work for you, you could pay them, as an employee out of your company, shifting income, reducing tax brackets. There's all different kinds of methods, that could be done based on your situation, from a high level strategic planning standpoint to help you save money. And that's what I do as well. It's not just about the basic compliance work. As far as doing a tax return at the end of the year, I'm here as an advisor for you guys, throughout the year to help you save money when it comes to do the taxes at the end of the year. All that is done strategically throughout the year. At the end of the year, it's too late to make a lot of changes. Okay, so certain aspects relative to being a real estate agent, such as entity selection, I could help you with that. And that was actually the main focus of today. But there's a lot of other areas down the road also that we could talk about that could also help you from a strategic tax saving standpoint as well. So with that said, I kind of covered a lot. Does anybody have any questions? I'll open it up to that right now. Okay, I'm gonna look in the chat. I do see a question. PA or LLC, S Corp, correct? Not just PAS. Yes, that is correct. You could set up an LLC, and then you could elect the LLC to be taxed as an S Corp as well. It doesn't only have to be a PA. Okay. There's really no advantage of doing the LLC versus a PA. An LLC is more geared towards if you have multiple partners in a type of business where it shields each partner, the acts of each partner against other partners. It's also used a lot in real estate investing, where you have a structure set up with multiple members owning various real estate portfolios, and that's set up as LLCs. You could also do a combination of LLCs and S Corps in that case. A single member LLC, although it's not good for a trade or business, which is the real estate sales is considered a trade or business. It is good if you just own real passive income like rental real estate. You could set that up as a single member as a single member LLC. It's just reported on the Schedule E in your personal return. No separate filings, but it gives you some asset protection. So if you're working with any clients, any real estate, if you're working with any investor clients and you see they have LLCs, single member LLCs, the reason for that is from an asset protection standpoint, not so much from a tax standpoint. So it's good for you to be aware of that if you do work with investors. And like I said, I'm also here as a resource for you guys with your clients. There's quite a few times I've saved a deal here and there. If a client may think they own a lot in capital gains if they sell their property, it may not be as bad as they think. And I could work with the potential client or the potential listing and helping them with that. Like I said, I'm here as a resource for you, for your clients, not just for your tax situation. Let's see what we have here. LLC was established in 2022, but did not file 2553 doesn't S Corp. Can this be amended or is it too late? Okay, if it was filed, now what I mentioned before is I can go retroactive and still convert it to an S Corp if it was established in the year of the tax filing season that we're doing. So in other words, we're filing 2023 tax returns. If you went and did it yourself and set up an LLC, let's say in January or February, but didn't do the S Corp election, I can go back and retroactively elect for it to be an S Corp as of the date of setting it up. Now, let's assume that you set it up the prior year, 2022. If you did not file any tax returns yet, okay, if you're late on your filings and never filed a 22 tax return, I can still go retroactive to 2022 to set it up as an S Corp. However, once you file a tax return as a single member LLC or as a Schedule C in your personal return, then I cannot go retroactive and change it. The soonest that that could be converted to an S corp is January of the current year. So let's say you have an LLC that you set up in November of 2022. You filed your tax return in 22. You did the Schedule C on your tax return, and now you realize that it should have been an S corp, and now 2023 is already gone, and you're still not an S corp. The soonest we can do it is January of 2024 of this year. And that form, the 2553 form, which is the S corp election application, needs to be filed by March 15th of the current year to be effective as of January in that current year. So the soonest you could do it would be January of this year, January 1st of this year for that. Okay. PLLC. State of Florida doesn't recognize PLCC. Some states, as a realtor, it's PLLC. In the state of Florida, it's PA. So, but it's basically, again, it's the same thing. It's just a corporation. Can you touch on self-employment tax credits? A lot has been talked about. Yeah, that is a credit that is out there. There's also R&D credits. The self-employment tax credit is something that I could help you with, but it's kind of beyond the scope of this class right here. If you want to talk about it further, we could do a one-on-one on that and make it very simple. You can just go to my website. I have a booking link on there. Just schedule it. We could, do it for 15 minutes, a half an hour. I give complimentary initial consultations, and we could talk about that further. No problem with that. Let's see. If a PA expired in 2023, can you reopen and amended for 24 purposes? And if it was not added to DBPR brokerage. Okay, so if it expired in 2023, I guess you're talking about not doing the annual report with the state. If you don't do an annual report every year with the state, the entity basically becomes inactive, administratively dissolved. I think that's probably what you're referring to. Once an entity has become dissolved with the state of Florida, you can reactivate it. It's a little expensive. It's about $700 or so to reactivate the entity. And if it's not added to DBPR, once you have it reactivated, then you can go to the DBPR, just like a new entity, and get it updated then. So that's not an issue. Can I add my car purchases on my time? Okay, as far as the car goes, yes, you can. There's two ways of expensing a car. One is using mileage. The other way, if you have an entity such as a PA, generally you use what's called actual expenses. If a car is over 6,000 pounds, up until last year, you're able to get what's called bonus depreciation, where you could expense the entire amount of the purchase. So if you went ahead and bought a Tesla Model X for 120,000, you could expense 120,000 on your tax return. Now, that's subject to business usage, of course. So if you use that car for 80% business usage, you write off 80% of that. If it's 90%, you do 90. If it's 100, you do 100. But it was 100%. Last year, it dropped down to 80%. This year, it dropped down to 60%. However, part of the new tax package that was just passed by the House, I believe one of the provisions is bringing it back to the 100%. So I need to research that a little bit. But the bottom line is, yes, you can use your auto purchase as a business expense if you use it for business. Obviously, as a real estate agent, you're in your car a lot. So yes, but you should keep track of your mileage, keep track of a mileage log when you're using it for business purposes. If you get audited, the best defense in an audit is backup, is support. So as far as my philosophy of being aggressive with expenses, a lot of it depends, there's a lot of gray areas in the tax code. A lot of it depends on how good you keep your records. So if you keep really good records and you could substantiate everything, I would be a little more aggressive with things because I know that it could be backed up. If you ever get audited, it's a hassle, but the chances are there won't be any big changes because you have the backup. If you don't keep good records, I would tend to be a little bit less aggressive or a little bit more conservative, because if you do get audited, then chances are you're not going to prevail and you're going to end up having to pay it back plus interest penalties. So there's a lot of nuance, there's a lot of almost like an art to it, in how aggressive and you want to be with expenses. Obviously they need to be legitimate. They need to be what's called ordinary business expenses that's used in your trade or business. In your state, real estate sales, anything related to producing the income as a real estate agent, that's generally a business expense. Whether it's marketing, whether it's going away on a conference, whether it's continuing education, whatever the case may be, if it's related to your business, that is a business expense. You go out for meals with your clients, that's a business expense. I don't have, and so on and so forth. Let's see. I don't see any other questions. Home office, all right. Do you adjust the real estate taxes? No. I've been in practice, like I said, about 25 years or so. I started specializing in real estate, I would say about 5 years ago or so. And so I do have other clients, not only in real estate, but that real estate is my main focus right now, my main niche. So yes, I do other taxes besides real estate. Home office, as a sole proprietor without having a separate entity, a home office, you can take a home office based on the square footage of a space in your home that you only use for your business versus the square footage of your entire property. You take a percentage, you do a percentage of your mortgage payment or your rent payment, utilities, insurance, all your various expenses, and that you could use as a home office expense. If you have a separate entity such as a PA, it's a little different. What you could do is reimburse yourself if you have an office that you use in your home and you set up as a separate entity, a PA, you basically reimburse yourself for the expenses of your home office. It's done a little, but the bottom line is yes, but it's done a little different. Let's see. Do I do taxes just in Florida? No, I have clients actually all over the place, pretty much almost every state. Since COVID, that actually expanded even more. I have a lot of clients I haven't even met in person that we work, with Zoom. I use a secure portal system, so it makes it very easy. Clients just upload the documents right to the portal. We do the tax return when it's completed. We set up a Zoom call, share my screen, we view the tax returns. All signatures are done electronically, all payments done electronically. So you could be anywhere. As a matter of fact, I had a call yesterday from someone in, where was it? I think it might have been France, actually. It was a referral from one of my realtor clients that's looking to buy some property in Miami and Switzerland. It was someone from Switzerland. So yeah, I pretty much international, and I do international taxation as well, which was kind of an outshoot of working with a lot of realtors in Miami. A lot of realtors work with investors, for national investors, and there's certain business structures for international investors, so they can be exempt from what's called FIRPTA, if you don't know what that is. If you're a non-resident alien that sells real estate in the United States, they're subject to withholding on the gross proceeds of the sale, not on the net profit, but on the gross proceeds. So that could be quite expensive, and quite a lot of money that's held back. There's ways of avoiding that by having the right business structure, and I help with for national investors having the right business structure also. So if you work with foreign nationals, give me a ring and I can help you with that as well. How much can you deduct for use of your home as an office? I covered that a little bit. It really depends. Generally it's based on the square footage of the space that you use exclusively for business versus your entire square footage. You come out with a percentage, and based on that, you use that against your various household expenses. Do you advise getting a business credit card and putting all expenses on one? Yes, absolutely. I advise either getting a separate business credit card, or if you have multiple personal ones, use one credit card strictly for your business purposes. That way it makes it much, much easier for tracking. That way, everything on that particular card is related to your business, and then you don't have to start siphoning through it. This is personal, this is business, this is personal. Everything there is for your business, and it makes it much, much easier. Do you prepare taxes for Delaware entities? Yes, I do. And I also could set up Delaware entities as well. Well, now they're really coming in. I can't keep up with them. Are you available for a webinar? You're talking about a webinar for an office? Yes, I do them all the time. I do office presentations. Just reach out to me and we can set it up. Obviously, this time of year, tax season, it's a little more difficult, because of my scheduling. But yes, I do them. Is the S Corp only has only expenses and QM but no income? Do we still file quarterly if we know that there'll be profit? Okay. Once you get the payroll set up, even though there's no yes, we'd still need to file it quarterly, but we could file it with zeros. Okay. Like I said before, there doesn't have to be actual payroll recorded in each quarter. It depends on your activity level. But once the payroll enrollments and once they're all set up for your entity, you still need to file it regardless of whether there's payroll or not, but it's filed with zeros. So if let's say a certain quarter, let's say we're in the middle of March, and you have some closings coming up that aren't going to close until, let's say, April, okay? The first couple of weeks in April. We could do the first quarter, which is January through March, with no payroll, and then we could do the actual payroll in the second quarter, which is April, May, and June. The reports are due the month after each quarter. So the reports for the second quarter will be due in July. So yes, you need to file reports, but you don't necessarily need to report payroll in every quarter. Okay, do you handle corporate payroll as well? I'm not sure what you mean by corporate payroll. The corporation is the payor. So yeah, so it is corporate payroll. I'm not sure what that question is. What kind of company can one set up if the person sells real estate but also does consulting for business? Thank you. Okay. Generally, you want to keep your PA separate for your real estate. And then if you also do any other type of business, like any type of consulting work, whatever the case may be, you really want to have a separate entity for that. You don't want to mix things. From a liability standpoint, it's not good. And from a licensing standpoint, you want to keep all your real estate separate in a separate entity. What is the best option for an LLC and car expenses, mileage or actual expenses, gas, which is a better option? Okay, generally for a sole proprietorship or a single member LLC, which is a sole proprietorship, generally mileage works out better in most cases. For a business corporate entity, generally actual works out better. And for those that don't know the difference, you have an option of either taking mileage based on a certain mileage rate, which changes each year, or you take what's called actual, which is a combination of gas, auto insurance, depreciation, interest on, if you have a car loan, you could expense the interest portion of the loan. That's called actual expenses. So it really depends. What I generally do is I look at both, from a client and see which way works out better. Okay. Can I pay my medical insurance with the business card? Medical insurance generally is not a business expense, it's a personal expense. So I would say no. You're better off keeping that separate and paying that out of whatever other personal credit card you might have. If you have a group plan through an S corp, you could pay that through the corporation. But it's with an S corp, it's reported a little bit different. We're not really going to get into that here. I can explain that in more detail if you want to meet one-on-one, but that's a little different. But generally, no, you want to, your medical expenses are a personal expense and you want to keep that on the personal side of things. Okay, is QuickBooks the best system to use? Like I explained earlier, QuickBooks is good. QuickBooks Online is great. With that, you could simultaneously be working in it. And as a CPA, as your accountant, I could be working in it at the same time. And at the end of the year, it makes it very easy. I'm also what's called a QuickBooks Pro Advisor. So I have kind of a platform with a list of all my clients. Just go in there. You know, a lot of clients, a lot of my real estate clients, I don't do the actual bookkeeping for. I do more on the tax side of things, do the payroll, do the corporate returns at the end of the year. And then some, I do some limited bookkeeping on keeping the, if you have QuickBooks, I'll basically look through it on a quarterly basis, make sure everything is categorized properly and coded properly, bank reconciliations. So I could basically do as much or as little as you need done, depending on your budgeting and depending on, you know, how much you want to do. You know, I have clients say, Don, you just handle it. I don't want to deal with it. I sell real estate. You do this, it's yours. So it all depends on what you want to do and how much involvement you want to have in the accounting and the bookkeeping and the tax part of things. What is normally the penalty if there is no quarterly payroll set? Okay, there isn't a penalty per se for not taking out any payroll. The problem is it's a big, well, actually, let me qualify that. There's no penalty per se as you go. If you get audited and you're not taking any payroll out, you're just taking what's called K1 income or flow through a profit from an S corp without taking any what's called reasonable compensation or payroll. If you get audited and it is a big hot button with the IRS can come back and they could reclassify and say, no, that's not profit. Who else is working for the company? What kind of business do you do? If you weren't doing what you do, what would the company have made? As a real estate agent, would have been zero because you're the ones producing all the revenues. So the IRS will come back and say, okay, you know, you took out $100,000 of distributions and not taking any payroll. We don't agree with that. We're going to say 90,000 of that is really payroll, and they're going to go back and reclassify that 90,000 as payroll, and you're going to have to pay all the back payroll tax as well as very, very stiff penalties for not paying in the payroll tax when it was supposed to and not filing the quarterly payroll reports when it was supposed to. It generally comes out to, with a payroll audit, generally around 2.5 times of what you normally would have paid had you done it properly. So there's no penalties per se as you go. The penalty comes in if you get audited. I would recommend not putting yourself into that situation and, you know, and taking out what you should to balance it out and not have to look over your shoulders. I've yet to have an audit on payroll based on someone who's taken payroll out versus someone who doesn't take any payroll at all. It's a nuisance. You know, you don't like paying the extra taxes. I don't like paying extra taxes, but it is a part of life, and it's a matter of paying what you need to, the least amount that you have to, without getting yourself into a jam where you end up having to pay more than you need to in penalties and interest if you get audited. So it's kind of like that balance of knowing how far to push things and how far not to push things, and that's where I come in to help you with that. What are fees for getting ITIN number for a seller? There's the fees, there's no fee to get an ITIN number. How that generally works is an ITIN number is applied for at the same time that the tax return is applied for. So if you have a non-resident alien who, let's say, has some rental income in Miami, they live in Peru, and they're subject to US taxes. They have to file what's called a 1040 NR. And in order to do that, they need to get an ITIN number. And assuming this is the first year they have that, they don't have an ITIN number yet, then what happens is there's a form that needs to be attached to the tax return, and the ITIN number is applied for at the same time that the tax return is filed. Okay, it's a little bit of a hassle because they have to submit their passport, the original passport with the return, but that's a whole nother topic. What are the keys? My client is a sell property. Yeah. So Maritza, if you want to give me, give me a shout out, we could talk about that. I could help you with that, and kind of go through the process in more detail of what needs to be done with that. Okay. So it's a PA tax as an S corp. You can't deduct any costs associated with health insurance. No. As one of the limitations with an S corp is that as a 2% owner, 2% or greater owner of an S corp, you can't take out what's called fringe benefits. Health insurance is considered fringe benefit. You can still deduct it, but it's done different. It's deducted on the personal return as what's called self-employed health insurance. As a C corp, you can deduct certain additional fringe benefits. And again, from a planning standpoint, there's a lot of factors that's weighed into it. You have the double taxation. In certain situations, from a strategic planning standpoint, a C corp may be beneficial. Okay, it doesn't have to be one or the other. A lot of times with certain clients in their situation, you do combinations of C corps and S corps if it makes sense. There's a lot of very high-end strategic planning that can be done, based on the situation. And that's an area that I get involved with also, is the very high level tax planning. And that's something, if you're interested in as well, depending on your situation, we could talk about that, on a one-to-one basis. And just put my website in the chat. That has all my information on there. My email, everything is there. Okay. I think, Kevin, are we good? I mean, this is an hour, right?
Yeah, it's however long you want it to be.
Okay.
Yeah,
how many people are still on here?
you did great. Oh, here, let me check. That's covered.
Does anybody else?
52. That's pretty good.
Anybody else have any questions?
If there are any more questions, you guys know how to get a hold of Don Fallenbaum. Don,
Yep.
I will also be sending you the RSVP list to this, so you can send
Okay.
out more information to them.
Right, great.
Someone just asked, do you have any help in Spanish?
Yeah, I do actually. Yeah.
Good.
Yeah, I could bring someone in. Yeah, Spanish as well. Absolutely.
Cool.
And again, I'm glad you guys made it today. Like I said earlier, it's a great time of the year to do it, the beginning of the year. If any of these strategies apply to you, it could make a real big difference for you, this year. And I'd be happy to help you out in any way I can. Just reach out to me, and we'll talk further. All right.
Excellent. Thanks,
All right.
Don, for all your help. We'll
right, my
hopefully have
pleasure.
you again
All
in
right.
6 or 7 months for
Yeah,
something.
perfect. All right.
Excellent.
All right. Take care. Bye.
Take care. Bye-bye.
Give up on my way.